This video is the sixth in the Creditism 101 series. It shows that when the United States stopped backing dollars with gold in 1968, that change unleashed an explosion of credit that fundamentally altered the nature of our economic system. The video demonstrates that credit creation, rather than saving and investment, became the principal dynamic that generates economic growth. In other words, the video describes how capitalism evolved into creditism. In 1968, the last year the Fed backed dollars with gold, $1.4 trillion of credit had been extended in the United States. By the end of last year, that figure had soared to $94.5 trillion. This explosion of credit fueled U.S. economic growth and made the economy much larger than it would have been otherwise. This video will show that credit could not have surged like this if money had continued to be backed by gold. It will also show that credit creation has displaced savings as the principal source of financing for the credit that has been extended. The $93 trillion increase in credit since 1968 meant that consumers have had much more money to spend on consumption, and that businesses have had much more money for investment and hiring. That credit-fueled consumption, investment, and hiring made the economy grow much more rapidly than it would have if credit had not surged. Credit became the main driver of economic growth. This chart shows that credit growth exceeded economic growth. The ratio of total credit to GDP increased from 160% in 1945 to 170% in 1980 to 280% in 2000 and to 370% in 2009. There are three major categories of creditors: the financial sector, the rest of the world, in other words, other countries, and the non-financial sector. We'll look at each of them in turn. The financial sector has extended $67 trillion of credit. The rest of the world has extended $15 trillion of credit to the United States, and the non-financial sector has extended $13 trillion of credit. The financial sector's share of total credit fluctuated from 64% in 1945 to a peak of 78% in 1973 to 71% last year, which can be considered relatively stable. However, we'll see that there was a very large and significant change in the relative amount of credit extended by the subcategories of this sector. The share of credit extended by the non-financial sector fell sharply from 35% in 1945 to just 13% last year, while the share of the rest of the world spiked from 1% in 1945 to 16% in 2023. We'll begin with a very quick look at the non-financial sector, then the rest of the world, and finally the financial sector, where we'll examine trends in its two main components: banks and non-bank financial creditors. The non-financial sector has extended $12.6 trillion of credit, or 13% of the total, with the household sector being the largest subcomponent, $7.1 trillion of credit extended. The non-financial sector is different from the other two categories of creditors in that the origin of the money it extends as credit has come primarily from savings rather than through credit creation. For instance, over time, households saved $7.1 trillion, which they have now lent out as credit. In the past, that was the norm for the entire economy. Savings provided the funds that were lent out. In this presentation, we'll see that ceased to be the norm after the Fed stopped backing dollars with gold. Most of the funds extended as credit today came into existence through the process of credit creation, not as the result of saving. Just one more point about the non-financial sector. It's important to understand that this sector would have saved far, far less if the other two sectors had not created vast amounts of credit and thereby made the economy many times larger now than it otherwise would have been. Now the rest of the world. In 1968, the rest of the world had extended $63 billion of credit to the United States. By 2023, that figure had increased to $15 trillion. In 2023, the rest of the world provided 16% of all credit extended in the United States. So why are other countries lending the U.S. so much money? The answer is very straightforward. Other countries lend the U.S. the dollars they obtain from their trade surpluses with the U.S. This chart shows the U.S. current account balance. As explained in an earlier video in this series, when dollars were backed by gold, trade between nations had to balance, as we can see here. But when the U.S. current account deficit began to explode in the early 1980s, so did the rest of the world's financing of U.S. debt. The cumulative U.S. current account deficit since 1968 has been $15.2 trillion. That means the rest of the world's cumulative current account surplus with the U.S. has also been $15.2 trillion. When other countries obtain dollars as a result of their current account surpluses with the U.S., they use those dollars to buy dollar-denominated assets, like debt securities. At the end of last year, the rest of the world owned $15 trillion of debt securities and loans. This represents the amount of credit the rest of the world has extended to the U.S. This chart shows both the rest of the world's cumulative current account surplus with the U.S. in blue and the rest of the world's holdings of U.S. debt instruments and loans in orange. It's very, very clear that the two lines move together. The rest of the world lends the money it obtains from its current account surplus with the U.S. back to the U.S. And the rest of the world will continue to acquire U.S. debt instruments so long as the world continues to have a current account surplus with the U.S. The next chart strongly suggests that foreign central banks own almost all of the U.S. debt securities and loans bought by the rest of the world. This chart shows total foreign exchange reserves in the world. They have increased from $77 billion in 1968 to $15 trillion last year. Central banks own the FX reserves. They obtain them by creating their own currencies and using that money to buy the foreign money, mostly US dollars, coming into their countries as a result of their trade surpluses. They do this to prevent the conversion of the foreign money into domestic money in the free market from pushing up the value of their domestic currencies, since appreciating currencies would put an end to the export-led economic growth that many of them rely on. When money had been backed by gold, foreign central banks couldn't create their own money on a large scale. If money had continued to be backed by gold during the years that followed, they couldn't have acquired trillions of US dollars, and they couldn't have extended $15 trillion of credit to the United States. But when money ceased to be backed by gold, they could do all those things. The reason the rest of the world has lent so much money to the U.S. is that foreign central banks have been creating their own money, buying dollars, and then investing those dollars in U.S. debt instruments and loans. This chart strongly supports the idea that foreign central banks are the real providers of credit to the U.S. from the rest of the world. It adds a third line, in black, showing total foreign exchange reserves, to the previous chart. The new line overlaps the other two lines. What this means is that the $15 trillion of credit extended to the U.S. by the rest of the world is money that was created by foreign central banks. Had the world continued to back money with gold, it would have been impossible for central banks to create money on anywhere near that scale. Therefore, this $15 trillion of credit would not have been available to finance $15 trillion of U.S. debt. Consequently, the U.S. economy would have grown much less and been far smaller today. Now the financial sector. This chart shows that credit extended by the financial sector increased more than 60-fold from 1.1 trillion in 1968 to 67 trillion last year, representing 71% of all U.S. credit. The financial sector can be broken into two parts: banks and credit unions, and non-bank financial sector creditors, as shown in this chart. In 1945, banks provided 40% of all credit, while non-bank financial sector creditors provided 24%. In the mid-1980s, the non-banks overtook the banks in lending. Last year, the non-banks extended 49% of all credit, whereas the banks extended just 23% of the total. In 1968, bank credit outstanding amounted to $630 billion. By 2023, that had increased by 32 times to $20.5 trillion. It wouldn't have been possible for commercial banks to extend so much credit if the Fed had been required to continue backing money with gold, however. That's because when banks extend credit, they create deposits through the process of fractional reserve banking. As deposits increased, the banks would have been required to hold an increasing amount of bank reserves. Bank reserves are created by the Fed, and up until 1965, the Fed was required to hold gold to back the bank reserves it created. It would have been impossible for the banks to have obtained additional bank reserves if the Fed had still been required to hold gold to back bank reserves, because the Fed didn't have sufficient gold holdings to support the further expansion of bank reserves. Unable to obtain additional bank reserves, the commercial banks wouldn't have been able to extend the $20 trillion of credit that they did extend after 1968. In that case, the U.S. economy would have grown very much less than it did grow, and would be very much smaller today than it is. Credit extended by non-bank financial sector creditors amounted to $450 billion in 1968. That had increased by 101 times to $46.4 trillion in 2023. Here they are, all the non-bank financial sector creditors, ranked by the amount of credit they have extended. Let's start with the Fed. The Fed extends credit by creating bank reserves. The Fed had extended $53 billion of credit in 1968. That rose to a peak of $8.8 trillion in 2021, a 166-fold increase. Clearly, that wouldn't have been possible if the Fed had still been required to hold gold to back bank reserves. Between 2021 and 2023, the credit extended by the Fed contracted from $8.8 trillion to $6.5 trillion. It contracted due to quantitative tightening, which reduces the amount of credit extended by the Fed. At the peak in 2021, credit extended by the Fed amounted to 10% of all credit in the United States. In other words, at that point, the Fed was financing 10% of all the debt in the country. Now it's financing 7% of all the debt. We looked at the rest of the world above and saw that the money extended by the rest of the world was created by foreign central banks. This chart adds together the credit extended by the Fed and by the rest of the world to show just how much of total credit has been provided by money creation by central banks. 23% of the total in 2023, down from a peak of 26% in 2021. Thus, money creation by central banks finances roughly a quarter, $21.5 trillion of all U.S. debt. It's hard to imagine how much smaller the U.S. economy and the global economy would be had central banks not created so much money. Now, for the rest of the non-bank financial sector. Stripping out the Fed, these institutions had extended roughly $40 trillion of credit as of the end of last year. Would that have been possible if money had continued to be backed by gold? No, it wouldn't have been. Above, we've seen that the banks, the Fed, and the rest of the world combined created $41 trillion of credit that they wouldn't have been able to create if money had continued to be backed by gold. If those three sets of creditors had extended $41 trillion less credit, then today the U.S. economy would be only a fraction of its current size. Consequently, all the other non-bank financial sector creditors would have accumulated far less money. Therefore, they would have had far less money to lend out as credit. So, for instance, if the economy had grown very much less than it has grown, then the mutual funds would not have as much money today as they do. And the same applies to life insurance companies, money market funds, federal government retirement funds, private pension funds, exchange-traded funds, and all of the others shown in red here. If money had continued to be backed by gold, in other words, then the economy would have grown far less, and all of the institutions shown in red above would have accumulated far less money to lend out. All of the institutions shown in red in the previous slide can be thought of as institutions where money is saved. That's not the case for the GSEs, the government-sponsored enterprises like Fannie Mae and Freddie Mac, or for the issuers of asset-backed securities. They're different. They grew by acquiring debt originated by the banks. Credit extended by the GSEs increased from $29 billion in 1968 to $11.7 trillion last year, a 400-fold increase. Credit extended by the issuers of asset-backed securities increased from zero in 1968 to a peak of $4.4 trillion in 2007. It then declined to $1.3 trillion in 2023. This chart shows the annual change in lending by the GSEs and the ABS issuers. Between 1998 and 2003, the GSEs, shown in black, increased their lending by an average of more than $500 billion each year. When they were then reined in by the Fed, lending by the ABS issuers surged to $750 billion a year in 2005 and 2006, shown in red here. This lending by the GSEs and ABS issuers caused the property bubble that wrecked the economy when it blew up in 2008. At the peak in 2002, GSE lending accounted for 17% of total credit extended in the U.S. Credit extended by the ABS issuers peaked at 9% of total credit in 2009. The GSEs, Fannie and Freddie, had to be nationalized in 2008 to prevent them from going completely bankrupt. Now the government effectively owns them. Most of the ABS issuers did go completely bankrupt. Combined, they accounted for 22% of all credit outstanding in 2002, 3, 7, and 8. Currently, combined, they're providing 14% of total credit, which amounts to $13 trillion. But where did they get all the money that they've lent? Where did those funds originate? Not from savings. It's well understood that banks create credit through the process of fractional reserve banking. Other non-deposit taking financial institutions are thought not to be able to create credit. However, I disagree with the accepted idea that non-deposit taking financial institutions cannot create credit. I believe the financial sector as a whole can and does create credit in a similar but much more roundabout way than banks do on their own. I discuss this in Chapter 9 of my book, The Money Revolution. It would take too long to explain how that works here, so let me approach this from a different direction. If the non-bank financial institutions can't create credit, then where did the funding come from that made it possible for them to extend $40 trillion of credit, given that the cumulative savings of the United States amounts to less than half that amount, only $16.9 trillion. This chart shows the annual savings of the United States, or in other words, net national savings. Adding all these years together gives us cumulative net national savings, or the cumulative savings of the country. The black line in this chart shows cumulative net national savings back to 1966, currently $16.9 trillion. This, in other words, is the total amount that the country has saved. The blue line shows all the debt in the country, $98.4 trillion. Notice the vast change since 1968. In the late 60s, these two lines overlapped. Now, look at the divergence. In 1968, cumulative national savings were high enough to finance 100% of the debt of all sectors of the economy combined. The ratio declined rapidly after that, and last year, cumulative national savings were only sufficient to finance 17% of all debt. So how then was the rest of the debt financed? It was financed through credit creation. At the end of last year, total debt in the United States amounted to $98.4 trillion. Cumulative net national savings of $16.9 trillion was enough to finance 17% of that debt. The rest of the world financed 15% of the debt, and the Fed financed 7% of the debt. That means the rest of the debt, 61% of the total, was financed through credit creation. So again, at the end of the 1960s, savings were sufficient to finance all the debt, but that changed rapidly, and now savings are sufficient to finance only 17% of the debt. The rest of the world has been financing more and more debt as their central banks create money and buy U.S. debt instruments. And the Fed has been doing something quite similar, creating money and buying debt securities. But all the rest, 61% of the financing for the credit extension, has come through credit creation. This means that the entire financial sector must be able to create credit, not just the banks. To conclude then, the total amount of credit extended in the United States has increased from $1 trillion in 1968 to more than $94 trillion now. This video has explained why such an extraordinary expansion of credit would have been impossible if the U.S. had continued to back dollars with gold. After dollars ceased to be backed by gold, Credit creation replaced savings as the source of the funding that financed lending. Credit creation and consumption, rather than saving and investment, became the dynamic that drove the economy. This development marked a fundamental change in the nature of our economic system. When credit creation became the main driver of economic growth, capitalism evolved into a different type of economic system, creditism.